very iffy on my voice. I had a cold. I still have a little bit of a cold. So I hope my voice holds out. This is horrible. Look at this. Eesh. Talking to a friend of mine downtown LA, and she said, you know, they can smell the smoke, but they don't feel it's that close. But it is going fast, so they don't know what's going to happen. Oh, that's right. We have a holiday tomorrow. All right. So what is going on in the world? Let's see what we can talk about before the Fed, which is at 2 o'clock. We have the minutes of their last meeting. And they'll worry about the rest later. All right. So still, I'm just looking over at S&P. Oh, stupid CNBC. Right when I looked, they changed the screen. Ah. Treasury sells 22 billion of 30-year notes. How did that go? Wait, no, looks like it went okay. No, actually it went off at like 4.9. That's a little bit lower than before. So the Dow's down a teeny tiny bit. The 10 years at 4.675. Oh my God. That's really getting out of control. The Nasdaq's down a bit. Okay, so yeah, it's what it looks like. Oh, well, why don't we just take a look at these instead? 5 minutes, hours. Yeah, that's what's going on. So really we're just sort of like buried along the lowest of the day. The VIX is up at 18, much worse than yesterday, right? Hang on, let me make the volume lower. Rick Santelli has an especially annoying voice. Let's see. Dealers took less of the, so it was not a very good auction. Now I do want to hear what he says.
Do keep in mind that we tested yields that we haven't seen in a while, and even though yields are coming down a bit here, Kelly, I certainly don't think the pressure of upside yields is over by 8.
30 years, 4.9%. We cross 5, we're doomed. Wow. It was not a great auction, but it was not a bad, it wasn't a terrible auction. So we averted a disaster, basically. For the bonds, you can see they're a bit off the lows. 5 minutes, because we just had the auction. So you see what happened is we had the auction at 1, and they're just sort of starting to tick up a little bit. So it wasn't as bad as we thought, but it's not great either. It's just not as bad as people were worried about. That's going to calm the dollar down and help the other currencies go up a little bit. So, you know, Bank of Japan, they don't want to see anything below 63 for sure. And poor England is terrible currency. The euro is 103. Oh my God. What a disaster. Anyway, so back to PhilStockWorld, if I can find it now. Nope, lost it. Oh, way over there. That's why. Anyway, so super cold. And when you're looking at natural gas futures, I need a split screen. That's what I need. It'll be much easier. Energy. Ooh. Oh, that's a 5-minute chart. So when you're looking at natural gas futures in the short term, it's all about how many home heating days there are. And that means days in which the temperature falls low enough where people would switch their system to heating. Like in Florida, well, I mean anywhere really. I mean you have heating and cooling in your system, and usually it's one or the other, but like in the spring you kind of leave it off and you deal with the temperatures or whatever it is. But there's I'd say if the temperature goes below 65, people tend to put on their heaters. So let's say for days below 65. And so when you have a map like this, and you see this, it means, all these people are below 65, and that means and it says 12 to 25 below normal. So you're going to have millions and millions and millions of more people using natural gas and using energy to heat their homes. And that drives up energy prices, and it's going to last for a while. I'll tell you right now. Let's see. Weather, long term. Wow. I see in Florida 2 entire weeks where we only see 60 degrees on the lows, not on the highs. We only see 60s one time. Saturday's the last day. Saturday's the last time we're going to see 60. It's 47. These are lows, 47 today. The highs are in the mid 60s this week, and they start going down to 60 next week. So it's getting colder and colder for 2 weeks. And that's southern Florida. So this is bad, okay? It's much colder than usual, and that means a lot of people are putting on their heaters that they don't usually put on. And in fact, I'm hearing that a lot with my neighbors and stuff down here, is people are finding out their heating system doesn't work because they haven't used it in like 2 or 3 years. That's how rarely it gets this cold down here. So it's a big economic change, and it's definitely going to cause see a few days of 25 to 35 below. Look at that. Whoa. A few days, so right now it's 12 to 25. A few days are coming 25 to 35 below the average temperature for this time of year. It's freaking freezing. So we got that to look forward to for the next 2 weeks. Meanwhile, California's on fire, and this is a horrifying fire. You get a lot of it out of this video. It's a decently done video, but using a lot of people's iPhone cameras and things like that. And then we have all Trump's goofiness going on at the same time. Ugh, look at that. There's a whole neighborhood like just going up in flames. It's so hard to find a house in LA too. It's so crazy. Of all the places to have that kind of fire. So got that to look forward to. What were we talking about today in chat? We were talking about the merger. That's not that important. IBZ. Oh, what else is going on? We got 10-year Treasury. The jobs report, the oil. There was actually a huge build in oil. So where's oil hanging out now? Energy. Oh, look at the crash. Oh, that's so good. We bet that. Yes, nice. So here. Okay, so here's the thing about oil. Where do I see? All right, let's see. OIL. Okay, how about 1 of 10? So I just want you to understand how this stuff progresses. Okay, so we're reading the news and doing what we're supposed to do. And I say that the rising dollar is putting downward pressure on everything, but not enough that oil is not testing 75 for the first time since October. So, 75 is pretty good resistance. So these are the facts as they build up, okay? I said today it's more about the very cold Arctic front that is put. So in October, it was the Middle East war. That's when Israel had the attack and all that stuff. So that was driving it higher. Because there was chaos, in Israel. And today it's more about the very cold Arctic front that's caused by global warming, and not the repudiation of it. Forget that. Not only does the cold increase demand, but it is so cold that the weather is shutting down production. It's so cold, this cold, that they're shutting down wells. It's causing the lubricants and things that run the wells. They start freezing up, and the wells don't work, and you have a danger of breaking them. So you have to shut them down. It's below the operating temperature. It's like when your car won't start because it freezes out, you know, because the radiator freezes if you don't have the antifreeze and stuff. And of course, we have the Ukraine is bombing Russian depots. So Russian oil production is coming below OPEC's targets. Also, by the way, Russian oil production would be for, it's being sucked up by the Russian war machine. You know, these tanks get like, they're like 2 gallons per mile to run these tanks. And so Russia running a war that's long range or medium range, not long range. It's not like, you know, it's not like they're in Korea or something, but they're running a war that's medium range from their country. That's a lot of fuel that's being used. So a lot of Russian oil that would be hitting the market otherwise is actually just going to their war machine. And that's a problem too. There's a lot of use on that. And then China is at the same time, China is saying they're going to start stimulating. So there's speculation that there'll be more oil use there. This one was a false flag. The US's main hub at Cushing had the lowest levels of oil in tanks since 2014. But honestly, it's not that much lower than it usually is. It's just the lowest. We happen to hit the lowest. And that's the kind of stuff that gets fed to news people by oil traders to try to jack up the prices. They give them these factoids that suddenly appear, which is nothing anyone usually cares about. Then I said last night's API report showed a 4 million barrel draw in crude, but when you look at the API report, there was a 7 million barrel build in gasoline and a 3 million barrel build in diesel. So your net is a $6 million build, not a 4 million barrel draw, but everybody looks at the headlines in these reports. This is how we make money. So at the time, I was in the middle of writing my morning post, so I started talking about like, and I said, so that's the manipulators who've gained control of the market to start the year. So that was it. Then we went on to talk about other stuff that's going on in California and so on and so forth. But then when I got to the chat, oh, well, I guess I can find it. Whoop, that was fast. So when I got to the chat, then Warren, when he did his report, he talked about oil a little bit, and I came back. Oh no, then he says sector highlights. That the oil stocks are moving up a little bit. Oh, that was a clue, by the way, though. When he said Chevron and Exxon, I took a look at and it was only 0.3%. That seems odd if oil's back over 75, right? That's not enough of a boost. So that means that the people who know oil best, the people trading energy stocks, are not seeing a very bullish thing out of what was going on. Therefore, I get suspicious. So that led me to get back on that horse with my comments. And I said oil is back to 74.24 ahead of EIA for reasons I noted above. Brent hit 79 before. So far, CL is only down from 75.29, and Brent was down to 76.85 and was down from 77.89. So oil is not going down as fast as Brent. And I said if oil fails to hold NG, and NG is cracking. Wait a minute. I'm pretty sure I said to short it. Maybe I didn't. Silly me. Oh, I did right here. Oh, I see. Because at the time it was 10:30 and the API and the EIA report came out, and the EIA report was terrible. The EIA report showed 12.4 million barrels of gasoline and distillates building, and that's after building the week before by 14 million, and only a 1 million barrel draw in crude. So net 12.4 million barrel build after a 13 million barrel build the week before, and that's Christmas and New Year's. This is through January 3rd. So Christmas and New Year's, massive, massive builds on a holiday weekend. So that's awful. And so that was so bad that I then said, yeah, let's short oil at 74.35 with stops above 74.50, which means that this drop in gold to 73.37 is a $2,000 gain since the open. How's that? That is very, very nice. Congratulations to everyone who played. I did not. I was very busy and didn't get around to it. So where were we? We were talking 74.50. So here we are at the open. Here's the inventory report at 10:30. That's 10:40 right there. When it was 35, I said short it with a stop at 74.50. It has gone down and down and down and down, and that's how you make. No, I'm sorry, it's not 2,000. It's 1,000. That's how you make $1,000 per contract in a couple of hours. So very, very good oil trade. But you see what it was? Because I'm writing that morning report at like 7:30 in the morning or something like that. So I'm writing the morning report at 7:30. At 7:30, oil is up. Here's the thing. So at 7:30, oil is up. At when I'm making my opening comments in the morning, it's down a little bit. And the evidence starts coming in. And when we finally get that inventory report, we say we looked at the API report, which had come in last night. So here's the API report. That was taken as bullish because the headline, but not the total amount. The headline was a 6 million barrel, a 4 million barrel draw, but it turned out to be a net 6 million barrel build. If you looked at the report properly, nobody looks at the report properly. People don't know how to read these things. Oil traders don't know how to read these things. They just run on the sentiment of what's happening. So here's that trading. Then there were all those reasons to bring oil higher, but there's so many things going on that they were being pointed to. They were just using an excuse to take it back to 75. 75 didn't hold, so you're going to get a retrace anyway. We come down, we come up. Now we're up to speed with where I was writing the article. I at that point didn't have the conviction to go short, but by 10:30. I had the conviction to go short because we have now the API report and the EIA report. Both tell us we had a huge build on the week that ended January 3rd and the week that ended 7 days before that, whatever that works out to. I don't know. Oh, I guess we could look. It's like cheating. So the week of the Friday, January 3rd and Friday, December 27th. So they were both clearly including the entire holiday week before and after the actual holiday. And I mean, how could it be worse? How could it be worse than having a 13 million barrel build each week of Christmas and New Year's? I mean, what is it going to take for people to understand that electric cars are killing the demand for oil in this country? Not just electric cars, electric buses, electric trucks to some extent, UPS electrics, Amazon buying 20,000 electric cars, Uber drivers driving Priuses, or no, either Priuses or Teslas now. It does make a difference. And by the way, this is how you save the planet. Little things do make a difference. This is in the 70s when we used to have a lot more pollution than we have now. And the pollution was littering, it was smog, smoke, and all this stuff, and factory exhaust and all this stuff. And the campaign at the time, it was everybody do your share and we can fix this. And that's what actually happened. Everybody stopped using aerosol spray and we'll fix the ozone layer. It doesn't have to be one great big thing that happens. It's everybody's just stopped using the stuff. One way or another, figure it out. Buy the brands that don't use aerosol, so on and so forth. You can make a difference. You can have an impact on the world if you just get enough people to do something. And that's what we're doing now. It's enough people are starting to use electric vehicles and find alternate ways of energy and so on and so forth that, and even electric lawnmowers. There's electric lawnmowers now. There's little robots that do things that used to be gas. There's electric leaf blowers that don't make noise, which is really weird. And yeah, you can say, oh, they're not as good, blah, 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 but they will be as good. I don't think anybody thinks an electric screwdriver is not better than an old screwdriver or something like that. It takes time for them to figure it out, but they will over time make it better and better. So some people are willing to be early adopters, and some people will line up later, but eventually it'll be clearly an advantage to have electric stuff. So anyway, so demand is breaking down. That's the bottom line. So that's a successful short, very good. But that's how it works, you know. We have to go through the logic of something and pick it apart, and if we see something that's not right, and we figure out a way to bet on it, that's what we do. And now you're all up to speed. So now let's look at that on a broader picture. What's that noise? That was really loud. I have no idea what made that sound. Anyway, what was I going to do? Oh yeah, I was going to find yesterday's post. So we did our $700 a month portfolio review, and we actually lost money. We went down to $35,858. We haven't lost money in a long time. So we lost $2,429 out of 35,000 is whatever percent. I didn't do the percentage. Doesn't matter. It's like 0.5%. No. It's like it's 5%. We lost 5% since the last portfolio review, basically. And that's because the Russell dropped 5%, and that's because obviously in this small portfolio we only have small cap companies, so that's going to track the Russell very closely. But we're still on track in 10 years to get to $1 million. So if you want to start now, you need $35,858. You're going to add $8,400 a year. We're going to give it 10 years to grow. We're averaging 30.64%, and you will have in 2035, you'll have $1,001,000. We were way ahead of this pace last month, but now we took a step back. But still, it's a pretty good pace. Well, there's what the S&P was doing. What is this? Oh. Login. Oh, come on, what? User ID or password you entered is incorrect. Really? No? I don't get it. I have no idea how to log in then. What is this? Oh, man. I am so confused. I have no idea what my password is. Nope. All right, well, can't show you. Anyway, the S&P is at the moment, it's up about 6, so it's still in the same place, basically. It's around 59.80. And we're stuck below this line, which is the top of our range. So it's basically getting stuck at the top of our range makes perfect sense to us, but we're still above the 50-day moving average, way above the 200-day moving average. And remember, once the 200-day moving average crosses, and we knew this would happen around earnings season, if the 200-day average crosses up, and notice how RSI is only 50, so we were oversold here, and the MACD has come down also, so this is also kind of oversold. So we have every reason in the world to go up. So the only thing that's really going to make us not go up is bad earnings. And if we can't get back over 6,000 in January, well, it is January, isn't it? If we can't get back over 6,000 into the end of the month from the earnings reports, that means the earnings reports are bad, because there's no excuse for not going up right now other than bad earnings. Too strong dollar and bad earnings are really the big factors. So we'll see what happens, and we'll see what the Fed says shortly too. So I don't want to dwell on that too much. Won't worry about that. It is what it is. And And here's all the trades from this portfolio. Oh, you know what I could do? Maybe I could let's try this. Nah, because then you can't really see it, can you? What can I do about it? Can I make this bigger? Control plus. Control plus. Oh yeah. Why it doesn't seem to be expanding like I thought it would? Huh, that's bigger. I hope you can see that. All right. So now we're doing that, and then I'm going to open up another window. Whoa. And I'm going to put that window over here. Let's see if this works for you guys. All right. Because I want you to be able to see the trades we're talking about to whatever extent we can. Ugh. What are you doing? Oh, because that was not the thing. Here it is. I hope you can see that. All right, so hopefully now when we review it, it'll make more sense. So now keep in mind that when we do these reviews, you shouldn't look at them as like, oh, I missed that trade, and you know, so what's the difference? These are trades you could take right now. So Ford, taking a look at it, right? They're kind of low right now. They're low in the channel, but overall auto sales were pretty good. There was a huge disruption in the auto industry where they got hacked for a couple of weeks. And they still had, you know, record high sales. Not Ford particularly, but I'm saying the overall auto industry had a good year. So, you know, Ford's like Coke and Pepsi. You know, like they could have a good year. You know, GM could have a good year, Ford could have a good year, whatever. It goes back and forth. You don't sell it off and go, oh, they're doomed just because they have a bad year or a bad quarter. And frankly, they didn't even miss their earnings. You know, earnings were good the last quarter. They went up and then they lost their enthusiasm, but I don't think there's any reason for that. So we like them. And we've already adjusted it. So what this is this is a $5,348 spread, which is a weird number. And what? Oh, that's because we have 14 calls. We have 14 longs and 14 shorts. So it's a 53.48 spread. It's only net 27,170. It has a $3,000 upside for 146% potential, 2% in fact. As an accident of upside potential, and I said right there, that's good for a new trade. That's not good for a new trade. I don't know what is. And what does Ford have to do? It's a we took this spread in September. It's currently flat. It's currently the same price we paid for it. It's the 8-11 spread. So that means that this spread at $9.92, let's call it $10. This spread is $2,800 in the money, and you can buy the spread for $2,170. So right away, you're getting a $630 discount off the top just for getting into the trade. You're already getting a discount because you're $2,800 in the money. It's a fact. The calls you're buying, the $8 calls you're buying, are $2,800 in the money, and you're only paying $2,170 for the $2,800 in the money calls. A discount. That's buying at a discount from the minute you start. Why is that? Because even though we're paying $305 for the calls, we're selling the short calls, which are way out of the money, for $1.48. So that just comes off our current price, and that's how we end up with the discount. So that's a fantastic, easy spread. Not aggressive because we're only looking for it to get to 11 something, so it's or $12. So we're only looking for it to get to $12, which is here in 2 years, and we're already halfway in the money on the spread. And all it has to do is stay where it is now, and we're going to make 800 bucks. And 800 bucks against 2,100 is not bad. So we're starting out with a profit that wouldn't be terrible. But if it goes all the way up, we're going to make a ridiculous 146% back on our money. So this is a fantastic trade. You got to look for these when you're looking at these portfolios. That's why we do it this way. Here's Hewlett Packard. Hewlett Packard is just zoom, 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 right? What's our spread on Hewlett Packard? We have the 15-20 spread. It's at 22. All right, but you know what's weird about this? It's a 2026 spread, so it's a next January spread. So 12 months from now, if we are still over 20, and 20 is down here, if we're still over 20 at the end of this year, the beginning of next year, okay, it's a net 3,600 spread. That'll be $5,000. We're going to make 1,400 bucks. That's 38% if it just doesn't go lower. This is what's fantastic about options, right? And again, same concept. We are selling more premium than we're buying. And by the way, we started this spread at net 1,600 and it's already at 3,600. So we already made $2,000. This is just the leftover scraps from our original trade, which we took back in June. So when we started this trade in June, it was $2,000 lower than it is now. We already made over 100% on this trade, still has 40% to go on top of that. All right. And now we like Levi. And we cashed out our early spread. This is our second shot at Levi because we already cashed out a winning trade on them. We're looking to get to it's currently net 22.75 on the $5,000 spread. And what's that spread? It's the 15-20 calls, 2027 15-20s. Levi's is at 17, so we're $2 in the money times 10 is 2,000. We're $2,000 in the money on this one, and it costs 22.75. So we were only paying $275 in premium, and we are potentially to make $2,500 on top of the premium. So we have 119% left to gain on this spread. That's left over to gain. When we started the spread, it was only a little while ago. You know, it was only December. On what date? December 10th. Yeah, so it really didn't move much. It's just a volatility change. So on December 10th, we grabbed this spread. It was net 2,200 bucks. It's still 2,200 bucks. So it hasn't really gone anywhere. But the upside potential is to get us another 27.25, 119% in 2 years. Here's Nokia. Nokia is a 3-4 spread. Boy, that's tight. A Nokia is a 3-4 spread. We took it in August. So here's August when it was below 3 or around 3. So in August it was at 3. We got super aggressive and we took 10 of the 3-4 spreads for the end of for next year, for 2026. And this was a really cheap spread. It was 1120 minus 570 is like 6,550, something like that. So it's about $550 on a $1,000 spread. And it is currently 775. So it's already up 50%. So it's up 50%, and we still have another 30% left to gain from the 775. Now, Paramount is a weird thing. They're getting bought by Skydance. There's no indication that the deal's not going through. The SEC hasn't even really raised any red flags on it or anything like that. They're just like, yes, please don't let them go bankrupt. So, you know, so Skydance is coming in with fresh money, and Skydance is, you know, they're a cool movie company, and they recognize Paramount has assets that are useful to them. Not to mention Paramount has Star Trek and things like that, and Transformers, and Skydance makes those kind of movies. They like the big action movies, so it's a good fit for them. It's really because the owner of Paramount, Sherry Redstone, is insane, and this deal's been dragging and taking time and details to work out and whatever. And to some extent, yes, she is ripping off the shareholders, giving them a terrible deal while she takes a great deal. But still, we did the math and we figured it should be about $12.50 by the time it's all said and done. And currently it's at 11. That seems weird, right? So this is $2,000 in the money, and the net of the spread is $21.60. So again, it's a very low net premium we're paying. We're paying $160 in premium, and there's $28.40 of upside potential. It's 131%. And we've only got until next January, also January. We have 1 year for this to go through. The deal should close by then, and it's just a patience play. I think it's just crazy that it wasn't getting recognized, although in the last few days it's getting recognized. And then thank goodness we have a hedge. Hedges are nice. The SQQ hedge. Now SQQ is a 3 times ETF. So if you have a 3 times ETF, where's calculator? Calculator. Here it is. Ooh, what's that thing? No, don't set as default. Ooh, that's why I hate asking this thing anything. What's going on? Well, that's perplexity. What is up with the Paramount / Skydance spread? What are the chances this thread does not exist? Isn't that weird? Oh, come on. How do I sign into this? That can't be me. You know, this machine is all screwed up for me. Email or phone. Okay, PhilStock. Oh, no. Oh, I don't know. No. Somehow Jackie's account is lead account on my machine. I guess she probably used it at some point. Ah. Oh, I give up. I have no idea what it is. Very annoyed. All right, so Microsoft Edge. Your browser's, no, not Microsoft Edge. What's the thing called? Copilot. There you go. Okay. What is the deal with Paramount / Skydance? When is it going to close? Is it definite? What will common shareholders get? So you think AI makes your life easier, but it really is it's a whole separate conversation you have to have. It's well underway. The go shop period ended. The deal is expected to close first half of the year. Under this deal, Class A shareholders at Sherry gets 23 a share. Class B's receive 48% premium to the stock price as of July 2024. Well, what the hell was that? Skydance will end up owning 70% of the shares outstanding. So long as there is no major regulatory hurdles, the deal appears to be moving forward as planned. Okay, so 48% more than July 1st. So now, got to do homework. And July 1st, before it was announced. Yeah, I'm not crazy. Here's July 1st, 1039. So it's 10 bucks. 40% more than 10 bucks is 14 bucks. I really feel it should be worth $12.50. I really don't understand why it's trading so low. Anyway, how did we get to that? Oh, that was before this one. Got sidetracked. All right. How we doing? Got some time before the Fed. There we go. So we have the 10-12.50 spread. Oh, forget that. That's over. We did that already. I think it's a really good spread. SQQ, that's what the calculator is for. So if it's a 3 times ETF and it's at 28.81. So all you do to figure it out is you go 28.81 times, if the NASDAQ falls 20% and it's a 3 times ETF, then this ETF should go up times 1.6. 3 times more, should go up 60%, because it's 3 times ETF inverse to the fall of 20%. That would take us to 46. And very smartly, we took the $40 call. So this thing would be fully in the money if the NASDAQ drops 20%. There's 4 of them. It's a $15 spread, so it'd be $6,000 if it goes. Currently, the net is only $930. So fantastic for a new trade, right? $930 buys you $5,000 worth of protection. So you're going to get a 5-to-1 payoff on a 20% drop in the NASDAQ. And we're hedging, so we would make $5,000 if the NASDAQ drops. Currently, we have $26,000 at play in securities. I probably should spend another $900 and move that to and bring that up to $9,000. That's a very, very good hedge. It's probably the best hedge in the market right now. And I'm sorry, that one goes until 2026. It's a 1-year hedge. You can make it a 2-year hedge. You can do a lot of things with it. But this is a very conservative portfolio, so we're just running it 1 year. This is the cost of 1 year worth of insurance. Is we spent $1,500. So we originally spent $1,500 to get $6,000 worth of protection, but currently we lost money so far, so it's down to $1,000. But still, that's been the cost of our insurance since November. All right, then we have AT&T. It's way in the money because it's a 15-20 spread. 20 is way down here. So all it has to do is not fall below 20 in a year, and we make 25.7%. Now, that's actually below our portfolio average. You have to be, here's why it's good to do the math, right? We're going to be below our portfolio average on this particular play, but you got to take into account it's like a sure thing. It's so unlikely that we don't make this money that it's kind of like, why would I have cash when I could make 25.7% leaving it here? So unless we run low on cash and need it for something, there's no reason to get rid of this trade. You always have to look at your opportunity costs. Like, what else would you be doing with the money? Here's Trox. I think they're way undervalued. We made a big adjustment. We spent money to adjust this one because it's so undervalued. and we're ending up with a $3,700 spread that has 4,300 of upside, 116%, and it is basically the December. Is it December of 20? Oh no, yeah, we're moving to December of this year, so it's December 8/12 spread, and currently Trox is at. It's at 9.57, so it's almost it's $1.50 in the money, $1,500 in the money, and we're paying $3,700 for the spread. But that's because it's and why are we paying $3,700? We didn't intend to spend $3,700 on the spread. We originally spent well, actually, you know what we did? I'm looking at it. We spent $2,700. We originally spent $2,700 on the spread. It did not go our way, so we put another $1,000 into it in order to so the net now is $3,700, but we still have $4,300 of upside potential. So we lost 1,000, and probably reflected right here. Well, this says we lost more. So we lost money on the spread originally. Now we're making an adjustment. Our net entry on the spread is now 3,700, and that's how we fixed it. And here's Walgreens Boots, and that one has it's 21.45 on the $5,000 spread. We're looking for Walgreens to get back to 12.50. It is currently at 9.50, so it's doing pretty badly. But we are $2 in the money with 2,000 in the money. Okay, so we're 2,000 in the money on a 21.45 net entry. So we only paid $145 a premium to get up to 28.55 in profit. This is how you trade. If you make trades like this, it's easy to make money. Just buy intelligently in the first place. Buy value stocks when they're cheap for good prices and sell premium against them, and you will make money. You know, if you consistently do something to make money, you will make money. It's almost like I'm telling you that if you take the eggs, take 3 eggs, and you break them in a bowl, and you add some milk, and you add some, some salt or something like that, and you stir it up, and you throw in some mushrooms, and you put it in the pan, you put the pan on the fire, and you flip it around, you know what? You're going to get an omelet. And you know what you're going to do with that omelet? You're going to sell that omelet for $8 to a guy sitting at the end of the counter at your luncheonette, right? And how much were the ingredients? The ingredients were $4. Therefore, you're going to make a $4 profit for taking 3 eggs, putting them in a bowl, putting some milk, stirring a pan, throwing in some mushrooms. All your ingredients are done. Put it on the fire. Give it to the guy. $8. You put in 4, you get 8. Now, sometimes an egg can be bad. Sometimes you could burn the omelet. Sometimes the mushrooms could be bad. You know, there's many things that can go wrong making the omelet, but usually they don't, because it's very simple. You take 3 eggs, you put them in a bowl, you put in some butter is good too. You put in a little butter, a little bit of milk, a little bit of salt, some mushrooms, stir it around, put it in the pan, flip the pan, give it to the guy, $8. Because when you're successful, you know what you're going to make. If it goes right, that's what you're going to make. It's a fact. What you have to do is go through the process. And the process is find a stock that's trading well below its value. Set up a trade in which you are selling more premium than you're buying. Then let time decay to take away the premium, and you're left with the value of the stock, and that will be a profit. It is just like that, but you need to understand it just like that. But if you follow this very simple strategy and you know how to select stocks, or you just follow the selections we make, because we make them all the time. I mean, we last year, I was looking back, we had 100 and something trade ideas last year. in 52 weeks. That's a couple of trade ideas every single week in our chat room. Every single week, a couple of trade ideas on the average. Sometimes there's 10, sometimes there's none, but overall, it's well over 100 trade ideas. We have 100 picks on our watch list. I'm only counting the ones that we actually executed. We have 100 trades on our watch list. I'm talking about the ones that we actually put into our portfolios and played. We have ideas all the time. But the point is, you look for stocks like this, you say, is it really that bad? Is WBA really that bad? And you know what? They're not, because they make $2 billion a year and they make it consistently. But you can buy the whole company for like $5 billion right now. It's ridiculous how cheap it is. They're priced like they're going to be bankrupt. But how are you going to be bankrupt when you make $2 billion a year? Investors hate companies that just make money. They only want to see expansion. If the company's not making money all the time, they don't even want to hear about it. But that's what this all is. It's a process, and you have to learn the process to make the money. But it's not, once you get good at it, it's no harder than than turning eggs into omelets. That's all you're doing. It's like, oh yeah, I know how to do that. Sure. I recognize something that I can sell for more money than it costs me to make. And you will not be 100% successful, but if you do it consistently, you got a business. Here's Blackstone Mortgage Trust. We own stock in that. They paid us a dividend, $94. We just collected on it, and the whole the spread is $22.93. We're collecting $400. Keep this in mind, because we get that 4 times a year. We're getting $400 in dividends. It's a $22.93 stock. So let's be exact about it. 96 times 4, it's $384, divided by the net cost of the spread, which is $22.93. That works out to 16.7% annually. Oh, I did work it out already. It works out to 60. Well, somehow that's not right. It works out to 16.7% annually in dividends. Now, there are many, many humans on this planet who think getting 16.7 back on their money is a great deal. That's just the dividends. There's another 56% upside potential on the stock, and we do have this stock set up for just 1 year right now. So all this stock has to do is be over our exit at 20. It's at 18 now. We're over the call strike. Okay, so we get called away on the stock, and if it's over 20, we get the 100% of the put money. If it's not over 20, then the calls that we sold for $4.35 at 18 would be $2, so we're still going to make money. They're all premium right now, and a very, very high likelihood of being a money maker. And again, when do we buy it? When it's low in the channel. See this channel? Very nice, very easy to follow, right? Low, that's low. That's high. You know, we might have been waiting here, might have been waiting here, but here it comes again, boom. It's in the channel, buy it. Okay. You know what you do up here? You sell. Or if if you're not going to sell, it's a good time to sell short calls or something else. But if you want to know when to buy it when it's down here. And if you want to sell it when it's up here. Because month after month, year after year, these things hold up. It's not that hard. The highs tend to hold up and the lows tend to hold up. What happens in the middle, no one knows. So when you see something in the middle, don't buy it. You don't know which way it's going to go. But if you see it at the top, that's a good sign it's going to go low. If you see it at the bottom, good sign it'll go higher. Because, these lines are formed by the decisions of thousands, millions of investors that went before you, who analyzed this stock, who looked at it, who ran the numbers, and so on and so forth. And they all said, this is where I think I want to buy. And these guys said, this is where I think I want to sell. And what's the trend? The trend is narrowing, and the correct price is probably going to end up where they intersect. That's going to be pretty much the real price for this stock, which also you could say if you bisect it, you say, well, there it is anyway. Now, SoFi, this is another one. I was banging the table on SoFi for 2 years. What am I doing? This is our second play on SoFi. And here we have 7 longs, we have 5 shorts on 2027. We have 2 open to sell again. So we sell 2 short-term calls in April, the 12s. And they're burning us right now, but we don't care if we get burned because we have the 10s. We will be able to roll these along and we will absorb that cost. Oh, here's the Fed. What's happening in the market? Fed seen at or near the point appropriate to slow the pace of policy easing. Well, there's nothing we didn't know. All right, we'll get to that in a minute. I want to finish this off. Anyway, so, this spread is already in the money and we're selling short-term calls. We roll these along. It still has 139% upside potential. Still, that's crazy. It's like, this is like free money. Honestly, this is just, it's look at the channel. Look at what this channel is doing. It's going up. The top channel is going up. The bottom channel is going up. And you can make 139% by just buying this spread. I mean, gosh. So these are trade ideas. When you see you can make 190% on a trade right now, that's a trade idea. Even though we started the trade a long time ago, what's the difference? It's now going to pay off 190%. Sure, it paid us 300% because we picked it up much earlier, but 190 is good too. So no dividend here, but the stock has popped nicely. We may as well sell 5 July 250 calls. So why? Because 250 is kind of a good point of resistance, and it's also it's up here. See this line? So there's resistance up here at 250. It already failed at 250. We don't have any short calls. So why don't we just take the money? This is only a $900 spread. It's like a $900 spread, and we're going to collect $500 to be called away at 1250, which is going to be thrilling to us, at 250, which is thrilling to us. Make 190% with this what then becomes a very conservative play. It's not our job to swing for the fences. We are thrilled to be up here, and we are going to sell our $500 worth of short calls, which are only in July. And when we get to July, we'll either get called away or we might roll them to a higher strike. But either way, this is going to be an incredibly profitable trade. And then last of all is Vail. So I said really underperform. Oh, that's Trivago. Wait, I put the same chart twice. How stupid. Anyway, so Vail, big loss here. It's a 1240 here. Oh, I'm sorry, there's a huge loss. It's minus 550. Minus 5,000 plus minus 1,200. If it wasn't for this trade, this portfolio would be up a mile. This trade's killing us. Imagine that this trade by itself is causing us a $6,800 loss in a $30,000 portfolio. It's 20% performance. So, but we're not looking to abandon it. It's just stupidly cheap down here. So we're going to buy 10 more of the $8 calls in 2027. Where do we have those? Oh, they're here. So we're buying 10 more of the $8 calls in 2027. And now we're just going to sit back and wait for it to recover. Will it recover? Who knows? But I think it's too good to let go of. I think it's a very mistakenly low price. Now we'll find out in Q1 when they do their earnings report. If they don't get a good reaction off of that, I may give up and say, forget it. Let's just walk away and find other things to trade. But if Q1 knocks them up, then we could be on our way to some massive gains. And I didn't count that as having upside potential because we're just trying to save it at the moment. It's certainly not working out so far. They're at 850. You know, I mean, this is support going back all the way to 2017. I mean, yeah, they went as low as 6, but when they were at 6, it was stupid, and they went rocketing back up. But 850 is a pretty good support line, but the same could have been said about 10 and 12. So they keep breaking support, but they have a 4.6. You know, they're trading at 4 times earnings, 5 times earnings. The problem is people are having trouble doing the math. And part of that reason is you get this with ADR stocks because their earnings are priced in reals, and then the metrics are all messed up, so the computers don't realize that they're very cheap. All right. So in other words, if you go to where's that thing? No, not you. Ay. Sorry, it's got rebooted. I guess all my things are missing. Ah. What is that thing called? Stock? It's not called stock charts. Hang on a second. It's called Stockopedia, damn it. There you go. Couldn't think of what that was called. Okay, Stockopedia. Just get me into Stockopedia. Ah, you know who I am. You better know who I am. Now, what were we talking about? Valet. I always say Vail. All right. So what's being? So here's the thing. See this? They're in Brazilian real. It screws up all the algos that follow it. Don't understand the earnings, and they tend to just sort of skip over it, even though the PE ratio is 4.6. I mean, it doesn't matter what your currency base is. They're making the value of the company, the market cap of the company versus what they're making. This thing knows how the translation works. It's 4.6 times earnings. It's crazy. You know, so if you convert that to dollars, this is 4.6. So it's about, 8 billion actual US dollars is the number you have here. And so they're making 8 billion a year. They had a lawsuit, and the lawsuit is big. It's like $20 billion basically they've got to pay out in the lawsuit. But they're paying it over 20 years. So it's only going to cost them $1 billion a year. And you know what? If you take $20 billion and you put it in the bank, you're going to make $1 billion a year in interest. So it won't really cost them anything other than the use of the funds. But they got lots and lots and lots of money. So, see this, they put money aside. See how the borrowing goes up? They put money aside to pay off the lawsuit. So overall, they're fine. And they make huge amounts of money. All they have to do is not get sued again. And the suit was because a dam collapsed. The dam that they and BHP had built together collapsed and wiped out an entire town. And so they had massive damages and a very unfriendly government putting the screws to them as well. So that's not likely to happen again. And they're certainly going to up their insurance on these sort of things. And by the way, they will get paid back some in insurance as well. So, you know, everybody looks at them like so negative, but the reality is this is a good, solid company. Mining, it's going to be necessary. It's a copper play. We love it. It's mostly iron ore, but they also copper. Iron ore, nickel. Oh, nickel too. Nickel's also really good. And then they have iron ore pellets, copper, platinum. You know, these are all metals that are in demand. And cobalt, that's another good one. This is a fantastic company. And you can buy it for nothing. So yeah, I'm going to stick with it. I'm going to keep putting money into this thing. This is a gold mine. Wow, it's a gold mine. Funny, huh? Anyway, all right, we're done with them. How about the Fed? F. Question box is in my way. Oh, that was awful. No, 2025. Not a future year. The future. Oh. We actually care about the 2024 meeting. 2019. Well, I'm glad I didn't use that. Got to be so careful. Oh, still fires. So it's the minutes of the meeting we want. We want to open that in a new window. We want to talk to who's available. Here's Warren. Hi, Warren. Do you remember from what was the previous minutes? La da da. Hang on. Let's see. What did I do with that thing? Oh, there it is. All right, so do you remember the minutes from? Oh yes, I was going to see what meeting it was. Damn it. Oh, I see, because it's over here. What the hell? Well, the format changed drastically. Do you remember the minutes from November 7th meeting? Do you remember the minutes from? See, this is the problem with an AI. He could know everything, but I don't know everything. So I got to look something up while I'm asking him. Do you remember the minutes from the November 7th, 2024 meeting? Okay. Doesn't really care who these people are. Let me skip them all of it though. I feel bad sometimes. I'm like, it seems like you're mistreating him because it's like, yeah, oh, just read this and give me a report right away. And he's like, yeah, sure. I'm telling you, it's like businesses that don't learn how to use AI are dead. How can you compete with somebody who does this when you have to go sit there and have, somebody come back to you in 3 hours with a report? And you guys have seen it. I can feed him the old meeting and he can tell me exactly what changed and what the differences are, but we don't need that. He gets the gist of it. Damn. Yeah. For an AI, this is a great report. It really is. Whoa, here's the thing. All right. So Warren says, my voice is doing so good. I'm so surprised. The only bad thing is Warren is based on the old GPT, and the old GPT, if you try to go page up, wait, I think I can go page up or page down. Let's see. Page down. Nope, doesn't work. So, the up arrows and things like that do not work in this box. I can't make it go up or down and do anything like that. I have to use the mouse, which is so annoying. The new one understands when you say page up, page down, and things. Anyway, so bitching aside, we can make it bigger now. I could just have him read it, I guess. That's another thing the new GPT does. But there are drawbacks. See, the thing is, I've trained Warren for 2 years. I've been working with him for like almost 2 years straight. And he knows a lot of stuff. And it would be, I can't just port him over. They don't have a way to just bring him over to the new system yet. And I did. That's what Cosmo is. Cosmo is like a new version of Warren, but he's not as good because he's too easily confused and distracted. Warren is like, I was gonna say Warren is like a machine. He's like a machine. He's like right on target. He gets his stuff. He knows what to do, and a lot of it is from experience. And he's just been doing this for so long with me that he understands what we're doing and gets what I like. So he's hard to give up, even though there may be better models. It's like an old car that you really love. It's like I can't give Warren up. I can't. I keep trying to make Cosmo better, and I'm constantly frustrated with Cosmo. And I go back to Warren, and then I say, okay, I'll get back under the hood of Cosmo and see if I can get him up to speed. But this is my reliable tool. This is my guy. He's amazing. He really is. Key points from the Fed meeting: the reduced Fed funds rate, the fourth cut. And this turns out to be a mistake. You can see it now. It's falling apart in the bond market. The committee signaled more gradual pace of rates moving forward. And how's the market taking this now? What's going on? First of all, I got to see where I am. Okay. So 5-minute chart. Oh, it's going well. They like the minutes. So big improvement from the minutes, although if you look on the hourly, it's not going to look very impressive, but at least it's something. It's better than going down. So the economy expanded at a solid pace. Headline and core eased, remained above 2% of target. PCE was 2.3. See, this is the importance of comparing one to another, right? Because you got to know what's changed. Employment growth moderated, unemployment edged up, wage growth slowed. And this is from the, this is from the November meeting until the December meeting. It's only a month. Wage growth slowed, but was still above the levels. Oh, damn it. Briefing.com. Damn it. Let's try that now. Yeah. Oh, it's not out yet. Shoot. So I was only for consumer credit. It's not out yet. Employment growth moderated, unemployment edged up, financial strain of the lower income households, business sentiment, optimism grew. This is what the Fed sees in their minutes. This is what the Fed's been looking at and how they view the market. Treasury yield stabilized. That's not true. It got much worse for them. Equity markets rallied, came down a bit, but still pretty high. The dollar appreciating against currency policies, that's still happening. Economic momentum abroad weakened. In Europe and China, that's still happening. Inflation eased. That is true. Upside risk to inflation were highlighted. Strong and expected activity. Downside risk, global economic weakness and deteriorating credit conditions, and that's happening still too. 2025 implications. Inflation remains somewhat elevated but continues a gradual downward trajectory. This is his interpretation. The minutes indicate a cautious stance towards further easing, emphasizing data dependency, slower pace of cuts. The Fed is likely to hold rates at restrictive levels until inflation aligns with the 2% target. Growth is expected to moderate, but remain positive. Consumer spending and business investment are likely to be key drivers. The Fed acknowledged that low-income households are feeling strain, while labor market conditions are easing. Wage growth remains slightly above the Fed's desired level. Softening labor market might allow the Fed more room to cut. Market participants should anticipate further divergence between monetary policy and that of other economies. That's true. That's definitely been happening. This could support dollar strength, complicating global trade balances and U.S. export competitiveness. Sticky inflation components, services and shelter costs may extend the disinflation timeline. Financial stability, elevated corporate and household debt levels could amplify risks if economic conditions deteriorate or borrowing costs rise. Oh, this is too much my voice. Borrowing costs rise unexpectedly. So outlook for the Fed policy, gradual easing. The Fed's decision to slow the pace of rate cuts suggests a deliberate approach to balance risk markets. Markets expect 75 cuts in 2025, which aligns with the Fed's stance. I'm not sure we're going to get that much. Balance sheet adjustment. I think we'll get a half a point. I'm not sure about 7.5. I'm pretty sure they're going to skip this meeting that's coming up, so we'll see. January 31st. Ongoing reduction in balance sheet assets will continue to tighten liquidity slightly, even as policy rates are reduced. The Fed will, that's true too. They're also reducing their balance sheet. So there's a lot of stuff going on. The Fed will closely monitor inflation, labor conditions, blah, blah, blah. With high uncertainty, the Fed is emphasizing flexibility and transparency to guide the markets. Takeaways. Treasury yields may remain range-bound as the markets digest a slower pace of easing. High-quality bonds could benefit from declining rates over time. Continued Fed easing supports a bullish narrative for stocks, especially in rate-sensitive sectors and technology. Oh, this is important, by the way, sorry. So high-quality bonds. So what they're saying, what Warren is saying, which is a very important thing to understand about bonds, if you have a bond that's paying 7%, right? Because you bought it in the last year or two when rates were really high. So if you have a bond that's paying 7%, if the rates go down to 5% next year, then somebody will want to buy your bond for the face value plus 2% bonus per year that you have left on your contract, okay? Because you have a 2% better rate of return than the 5. So if the guy went to buy a bond now for $100,000 bond now, and it paid, I'm simplifying it, it's not the way it really works, but if it paid 5% a year for 10 years, right? Then he would get back $150,000. Okay, it's not how it works. It's a whole weird thing where they discount what you pay and you get the face value, blah, blah, blah. But, you know, again, I'm trying to make it less complicated. Whereas your bond at 7% will get $170,000, right? Over the same period of time, over the same 10 years. So the guy, instead of buying his bond that's going to go to 150 using the same $100,000 that he starts with, right? Would rather offer you 165,000 for your bond. Or not 165, but I mean, well, less the interest, less the years left to accumulate, but he'll offer you a nice cash bonus, a very large cash bonus on the bond you own now. You'll get a lot more than you should have gotten at the time that you've allowed so far to go past. Clear-ish? Anyway, so the advantage that you have is you're going to collect more interest per year. So if that's 2% per year and you have 7 years left, you got 14% more, and your bond is actually worth 14% more than a current bond. And you can sell it for, let's say, 12% more, because people will get a discount, but they'll get the better value out of your bond. So there you go. That's what the bond market is like. Therefore, in addition to just getting your 7%, you get bonus money based on what people are willing to pay for your bond over time. Doesn't help unless you actually sell it, but if you sell it, you do have a better value. So you have an appreciating asset in your bond. That's what happens. So in a lowering rate environment, the bondholders make money and do well. And usually the rates are in a lowering environment. This is why stocks and bonds tend to go the opposite way. Because why would the Fed be lowering rates? Because the economy is weak. Usually the Fed is lowering rates because the economy is weak. So the market is going down, the economy is weak, rates are going down, and that drives bonds up, and that's why people like to balance stocks and bonds in the portfolio. On the other hand, when the economy is strong, stocks are going up, the Fed is raising rates to calm the stock market down, and the bond market, it's the opposite problem, right? It gets weaker and the bonds start falling in value. So that was a good lesson. Continued Fed easing supports a bullish narrative for stocks, especially in rate-sensitive sectors like technology. However, valuations at current levels could face headwinds if inflation risk materialize, and also the Fed is losing control of the bond market, and it's still going up even though they're easing, and that's a big danger for the Fed. The Fed has dropped rates in September 1%, and bonds are now higher than they were in September. So the Fed has drastically disconnected their discount rate from the bond market. The bond market is saying, oh, no, we're not lending the $36 billion indebted United States, where Donald Trump is coming in saying he's going to attack Greenland and cut taxes and you know, just, and spend. He wants to deport 12 million people. We did this once. I ran the numbers in an article once. He wants to deport 12 million people. Okay. First of all, if you want to send a person to, Buenos Aires, right? Whether you send them by car or boat or train or plane, you're going to spend $1,000. And that's not including the cost of having the police go round them up and detain them for a certain amount of time and process them in the courts and so on and so forth. That's thousands of dollars. So 1,000 times 12 million is 12 billion. Thousands times 12 billion is 30, 40, 50, $100 billion to deport these people. and we concluded in analyzing Donald Trump's plan that it's basically a scam to funnel money to all these people, fellow hotel owners, except these hotels are detention centers. But so his hotel owning buddies who own prisons and own detention centers are going to get billions and billions of dollars funneled to them. That's how we make America great. It's going to be an entire industry based on catching and rounding up and deporting people. Now, this is going to be a huge industry in America. Great growth. The dollar strength supported by interest rate differentials could pose challenges, and that's happening now because of everything's changing. Resilient growth is likely in 2025, but the risk of global slowdown and domestic financial strains could dampen momentum. That's exactly what's going on, obviously. The Fed's December minutes underscore a delicate balancing act, supporting economic growth and employment without undermining progress in reducing inflation. So yes, everything's slowing, so on and so forth. Now let's see what our buddies at the Wall Street Journal say about this, just to make sure. Sounds right to me though. Oh, Los Angeles still on fire. Oh my God. Wow. It's a huge house too. Okay. Balance. He's going to use the same word. I mean, you know, it's Warren knows what he's doing. He's going to use the same word. Balanced. Continue moving. Progress could take longer than anticipated. And they're talking about trade and immigration policy. Of the officials who participated, quarter point cut was appropriate, but officials thought there was merit in keeping rates unchanged last month, and the majority had indicated the decision to cut rates was a close call. So they're about done with the rate cuts. The minutes further suggest officials were broadly comfortable holding rates steady at their meeting at the end of the month. Officials thought under their current outlook and economic activity, the Fed would continue to cut rates at a slower pace than they had in recent months. So all good. That's where we are. That's what things look like. Oh, Daniel wanted to know if there was a trade I could suggest with UNG. Well, let's see. Okay, let's take a look. So natural gas. What is this noise? Oh, the Wall Street Journal. Where was I? Yeah. No? So your natural gas last winter, see, it bottomed out last winter. It was terrible. It generally trends up into the spring. Yeah, you know, it's hard to say because look at this. I mean, here and see here also the January and trends up. Oh, that you know, that's exploding up, but that's a whole different thing. So trends up. You can count on it usually to go up into May, but after that, it's a bad time for it. Again, rocky, but up. 2020, ooh, no, it went down and down and down and down. But if you hung in there, it was good. 2019, don't forget this is COVID, so everything's messed up. Down and down and down in COVID. 2018, nope, also not good. So still, this is not a terrible place, but you know, you missed the rally. It's not like you caught it. So I wouldn't want to get too aggressive about it. I don't know if I want to say natural gas is a good play. I would do something conservative. Let's look at Yahoo because I don't have anything else to look at right now. I can't find Yahoo. There it is. So if you're looking at UNG, see, that's a 5-year chart. Is it? Wait, no, it's not. That's a 5-year chart. So I think if you're going to play it, I would go pretty conservatively. And I would go with, what year would I want? What strike? I would go and say, I would make a play where I'd say it's not going to go down. So if you go into 2027, and we're currently at 17, and that's the last price bid ask. Okay, so let's say that we picked up the, you want to pay, see what you want to do is find somewhere where you're not paying a lot of premium. And that would be, let's say, ooh, it's a big discrepancy. $8 was the last paid there. $8 was the last paid there too. So I certainly would rather be in that one than that one. 877. Not, so how much am I paying for the next strike? Here I'm paying nothing, so you do that obviously. Here I'm paying 70 cents to go down $1. That doesn't seem worth it. Here I'm paying 40 cents, not quite, to go down $1. Here I'm paying 40 cents to go down $1. Here I'm paying, that doesn't even make sense. So that just simply hasn't been traded in a very long time. So 950, is 950 realistic? Is 9 realistic? It depends. You'd have to look more closely at the strikes and figure out which one's going to work. But let's say the 10s are more liquid. They're at 913. That seems like a reasonable price. And the bid is 7, and the ask is 10. I'm pretty sure you can get in there for $9. So if I bought the $10 calls for $9 and I sold the $15 calls, and clearly with the bid and ask are very close. If I could sell the $15 calls for $670, let's say in between the two numbers here, or I'm sorry, it's $650, $850. So actually you can probably do better than that. You can probably sell these for $7. So in other words, if I'm buying the 10s for $9 and I'm selling the 15s for $7, that's $2. So it's $2 on a $5 spread. It's a good trade. So in other words, you're paying $2 for the $5 spread, and natural gas is already at just about 17. So natural gas would have to fall $2 for you not to make 150%. See, you wonder where I get these trades from. This is how you put them together. So you gotta fill it properly, but this is not a terrible time to get a fill. They're just these prices are kind of high because natural gas has been flying higher. So you want to get these sales in and try to nail this thing down. I mean, heck, at $17 you can actually buy it and you net in for 12. If you buy it for $17 straight up, right, and then you sell these things for $5, you're netting in for $12. And if you get called away at 17, you're going to make $5. So that's still nice money, but I would rather buy the 10 calls and sell the 15 calls, because there you're paying $2 for the $5 spread. Can you sell some puts too? Sure, if you want to, you can find the puts and take a look over at let's say we sold the $15 puts. Oh my God, you can sell those for $4 at least. So if you can sell the $15 puts for 4, your worst case scenario is you own natural gas for 11, but you're into the spread, the 10-15 spread, you would be in for net -2. You hear that? You're in for net -$2. You have a $2 credit on a $5 spread, and if natural gas holds $15, you're going to make $7. That's how I would play natural gas. In fact, we're gonna write that out. That's gonna be a top trade. That's a freaking great trade. So on that note, we will end the webinar, and I will go back and do my job and alert the members of that trade. So thanks for the suggestion. Who was that? That was Daniel. Thanks, Daniel. We're going to make that an official suggestion for the members. It's great. All right. Anyways, that's the end of my voice. Have a great weekend, everybody, and we will do this again next week. All right. Lots of trading, and next week we're reviewing all the portfolios, so you can have 100 different potential trades to look at to start 2025. Do not tell me we don't have enough picks here. All right. Thanks a lot, folks. Take care.